Okay, class, good evening. How are you guys doing today? So I guess we can start our class immediately. This is already 8:17. We're supposed to start by 8:15. So we're going to continue from where we stopped last week. So last week we started looking at employee benefits. And last week we finished up with IFRS 2 on share-based payments. And I can remember I gave you some assignments. Those practice questions that you should go and look at them. So I hope you have looked at it. We mentioned last week that IAS 19 on employee benefits considers how you account for the consideration that an employer gives to its employees for the work they have done for them. And majorly, to account for employee benefits, we immediately focused on the categories of employee benefits that we can have, which we said we have short-term, the post-employment benefits, other long-term benefits, and termination benefits. We stopped at short-term last week, and today we are going to round up with the others today. For short-term benefit, I mentioned that majorly these are consideration given to an employee for the work the employee has done for that year, and they are usually given to the employee within 1 year. And typical examples are the wages and salaries we get monthly and our allowances, or any other consideration given to an employee within 1 year. And in accounting for that, I told you that we just need to establish when do we have an obligation. And an entity would have an obligation when the employee has worked for the employer. So as soon as the employee has rendered service to the employer, then immediately we have an obligation, and immediately we would need to account for an expense. So we debit staff cost, and we would also immediately credit accrued staff cost. And when we settle the obligation, we will net off the liability by debiting accrued staff cost and credit back. And I also told you that it's possible to overpay or pay in advance. That would be a debit to prepaid salaries or prepayment. However, I didn't mention that we could have short-term paid absences where an employee worked, or where an employee did not work, but the employee got paid. And these short-term paid absences could be the one whereby the unused leave for a year can be carried forward, or it could be where the unused leave for the year cannot be carried forward. IAS 9, that's non-accumulating, the one that cannot be carried forward. And there is accumulating, the one that can be carried forward. For the non-accumulating, where you have any unused leave, and the policy within the organization is that as soon as you do not use your leave for the year, it is gone. You will not get paid for that unused leave. That is non-accumulating. And we said that at what point are we going to account for this? The answer to that is, at what point do we have an obligation? And we would have an obligation when the employee takes the leave or when the event occurs. That is when we would have an obligation for non-accumulating paid absences. Since the situation is that if the employee does not take the leave, we will not pay. So we will only have to pay when they take it. And that is when we're going to book a debit to P&L as staff cost. And we also credit accrued staff cost. But the one that is accumulating, this will usually be recognized at the end of the year, where we would have identified the unused leave. The amount that would be recognized as unused leave will be an estimate of the additional cost that will be recognized. An estimate of the additional cost that will be recognized as a liability. So is whatever we estimate that the employee can take in the next year, whatever portion of the unused leave that they can take next year is our liability. So it might not necessarily be the entire unused leave that we will recognize as a liability. It might just be a portion of it. If our policy is that they cannot take all, they cannot carry everything forward, that even if you carry it forward, you cannot take everything again. So the question will tell us what can be taken next year from the unused leave. And it's at that point that you recognize ability and an expense. And we solve the question, specifically this question, to address that. There is profit share or bonus also. It's a short-term employee benefit as well. And for profit share, we would recognize it in our books if and the entity has, let's say, a profit target for the year, and have met profit target for the year. So as soon as the entity has no option but to pay that bonus, I mean, there's a target and we have met it. At that point, we will need to recognize the liability as an expense because they have to pay that bonus. It could be a scenario whereby there is no policy on at what point we pay profit share or bonus, that it will just be at the discretion of the management. If that's the case, then we can only book a liability when the management pronounce that we will get profit share. That is when they have an obligation. Those were what we learned around short-term employee benefits. Today, we will look at accounting for post-employment benefits. And like I told you last week, post-employment benefits are benefits payable to employee after completion of employment or at retirement. So we pay this benefit to our employees when they retire. Because the nature of these benefits, the nature being that is an amount that will be much later in the future. I mean, when people retire, people will not retire until after 30 years, some after 5 years, depending on age that you are now and the retirement age of your company. So it's an amount that will be paid much later into the future. For that case, organization would call this benefits, they would usually call it post-employment benefits plans. In fact, they simply call it plans because they will have like an like a benefit scheme or a plan that they would do to get ready for the huge amount of pay when the employee retire. So they will find a way to start paying that amount gradually, or to start keeping that amount gradually. Like in Nigeria, the post-employment benefit scheme that our PFA recommends is the one whereby the employer must contribute 10% of the gross emolument of that employee, and they must remove 8% from the gross emolument of that employee every month. So making 18% that is kept, that is paid into a plan, into a fund every month, keeping it for when the employee retires. So for post-employment benefits, there is usually a scheme or a plan whereby the employer can be keeping the money gradually, so that at the point where the employee retire, it will not be difficult to pay that money. It will be easy. So there is just a matter of taking from where you have been saving the money, then use it to settle the employee. However, this plan in question, there are two of them. It can be two. So employer can choose either of these two, not the two of them. It has to be one of them. So we have defined contribution plan and we have defined benefits plan. For defined contribution plan, the employer makes regular contribution to the scheme or to the plan. They make regular contribution. But the amount of benefits that the employee can get at retirement will be based or dependent on the performance of that scheme or fund where that money is being contributed to. Again, for defined contribution plan, the employer makes regular contribution into a plan, into a scheme, into a fund. They are paying, like in Nigeria now, they pay into a PFA, whether Stanbic IBDC, there are a lot of them, Sterling Pension, many of them like that. So they pay regularly. But the main thing about defined contribution plan is that the amount of benefits that the employee can get at retirement is dependent or is determined by the performance of that scheme or of that fund where that money is kept, which means that the money the employee will get at retirement is outside the control of the employer. It's outside his control. It is solely determined by the fund, in the case of Nigeria, by the PFA. It's the PFA you will go and meet when you retire, not your employer. And that shows in the way we account for defined contribution plan. It's very straightforward. I will get there very soon. But for defined benefit plan,
Now what for this your drive? Now what for this your drive?
the employer makes regular contribution ordinarily. It makes regular contribution every month or every year to a fund, to a scheme, but the amount of benefits that the employee will get at retirement is predetermined in advance by the employer. Again, for defined benefit plan, the amount of benefit that the employee will get at retirement is predetermined, is determined in advance by the employer. It's just like the employer telling the employee that when you retire, I will make sure that every month you are getting 2 million naira salary. That is a defined benefit plan. Or employer tells the employee that when you retire, I will take care of your medical bills till you die. Or the employer tells the employee that when you retire, I will take care of your children's school fees up to university level. See, whenever the benefits defined or specific or predetermined, that is a defined benefit plan. That's why they call it defined benefit. The benefit is defined, is known to all. Now, having understood what they mean, how do we account for each of them? You see, accounting for a defined contribution plan is very straightforward. Because as you can see, the employer does not have any obligation against the benefits for defined contribution plan. It doesn't have any obligation because the benefits the employee will get is dependent on the performance of the plan, of the scheme, of the fund in which they are keeping that money. So the benefits the employee will get is outside the control of the employer, is none of business. So in accounting for defined contribution plan, the focus majorly is how much obligation do we have? And usually the obligation we have is the contribution we have to make, either monthly or annually. That is the only contribution that the employer has to make, and that's the only liability that the employer has, is just to make regular contribution. Beyond that regular contribution, nothing more. So when you want to account for a defined contribution at the end of every month, when it is due to pay the contribution, you just book a liability. You can debit pension expense and then credit liability. Then when you pay, you cancel out the liability. But the point here is normal, it's just similar to short-term employee benefit. The obligation the employer has is just to pay contribution, and that is all. And again, if they pay in advance, let's say they pay to pension in advance, that again will become a prepayment. It becomes a prepayment because they can only expense the contribution that relates to this year. If you are supposed to be contributing 10 million every year, and you go ahead and contribute 20 million, you will only put 10 million in P&L. The remaining 10 million, it will be an asset prepayment. When it is due for the payment, but you have already paid in advance, you will expense that asset as well. So the key thing for defined contribution plan is the fact that we are only obligated to the monthly or annual contribution, and that is all. It's very straightforward. But for defined benefit plan, you will see that the obligation that the employer has is on the benefit that is payable in the future, because the employer has promised, has defined, has predetermined the benefit. So he has obligation on that benefit because he cannot avoid it. He has already communicated with the employees that he will pay them this amount when they retire. So he has an obligation to that benefit. So since this is a benefit or money that will be paid in the future, the first challenge we would have is, how do we determine this amount? Because some companies will have many employees, and each employee, they won't get the same benefits. The basis of determining their benefit will be different. Some of them might be 40 years, some might be 20-something years, some might be 50-something years. Benefit to be different in terms of calculation. So how do you even calculate the benefit? You say, okay, when you retire, I will take care of your medical bills. How do you calculate that? Not that. Another complexity here is, even when we're able to calculate this benefit, we're able to know an amount, attach an amount to it. What we say we will do for you guys when you retire, the total till you die is around 500 million. Another challenge is, how much are we going to be contributing every month? Because it's not like we'll go and keep all that money then at one place. No, we'll be contributing towards it. So another major hurdle is, how much are we supposed to contribute that will accurately equal to that benefit when the employee retires? Those are the two practical challenges that we have under defined benefit plan. How to calculate the benefits and how to even work back to the amount of contribution we are paying every month or annually to meet up with that benefit. Now, because of the complexity related to this, and serious assumptions and variables that are attached to determining these benefits that will be paid in the future, that we have promised to our employee, and also the amount of contribution that we have to make, there are a lot of variables attached in determining it. The standard calls all of this, it calls it actuarial assumptions, that in determining the amount of benefits and also the amount of contribution, it requires making actuarial assumptions. And that's outside the scope of what accountants are trained to do. So the standard recommends that we should outsource those assumptions. We should outsource the determination of the benefit and the contribution. It should be outsourced to an actuary. Those are professionals in making those assumptions. They would help us make those estimates and figures. So my focus today is not teaching you how to calculate those future benefits. My focus today is not teaching you how to calculate those contributions, because it will be contained in the actuarial reports. So if you're an auditor in practice, and when you look at the post-employment benefit scheme that an entity has for its employees, and you see that this one is a defined benefit, the first thing you need to ask for is the actuarial report on that defined benefit plan. If they don't have one, you need to get an actuary to help determine those figures. That is how it is done. We are not trained for that. In the exam, they will give you all of these figures. Now, what are the figures? What are the items you find in the actuarial report? That is the focus for today. But there's something, before I go to what you find in the report, there's something the standard calls projected unit credit method. Projected unit credit method is a method that IAS 19 recommends that accountants should advise the actuary to use when they want to determine the amount of benefit and the amount of contribution we need to make. The standard says we should recommend projected unit credit method. In that, the actuary must use an annual basis. Actuary must attach units to each year that the employee is going to work and use that basis to determine the amount of benefit the employee will ultimately get. Again, I'm saying that projected unit credit method means that the actuary must value that benefit on the basis of the number of years the employee is going to work for us. So it should attach benefit to each year. Meaning it should not just come and say, the amount of benefit is 500 billion. No. What you should come and say is that for every year the employee works for us, this is the amount of benefit he has earned for himself in the future. So it should not come with a benefit that will pay in the future, but rather it should come with, for every year the employee works for us, this is the unit the employee gets. This is the amount of benefit. So we're going to build up to that benefits as we move through time. That's what they call projected unit credit method. So convert each year to a, so be crediting each year with a unit. Okay, this guy has worked for us this year. Okay, it's due to this benefit. He has worked for us this year. It's due to this benefit. Because that's what makes sense to us accountants. We work with accrual basis. We don't recognize lump sum in our books. We want to have a sense of accrual. I mean, when has a transaction occurred? So we need the actuary to do that as well, to tell us that, okay, this guy has worked 1 year, then we owe him this benefit in the future. Not that we are paying that benefit now, is when he retires, but at least we have an understanding that if the guy leaves before retirement, we can easily know how much we owe him, because it's not everybody that will stay till retirement. So we can easily know how much we owe that particular person. And that's what projected unit credit method is talking about. Build it up on an annual basis, on a unit by unit basis. Now, the actuary will actually do that, and it will come up with these figures. And these are the figures they will give you in the exam. So our focus is not how to determine these figures, but rather how do you account for them? That is our own expertise, accounting, recognition, and measurements. That is what accountants are trained to do. So what are the items we'll find in our actuarial report? The first is contribution. The guy will have worked out the amount of contribution we need to make every year. And this contribution will be made into a plan asset. And a plan asset can either be stocks, mutual funds, real estate, insurance policies. So we'll be contributing, contribution is synonymous to investing. So in Nigeria now, it is compulsory that the employer must do 10% from his own hand. The employee will do 8% compulsory. Every year we're doing that, or every month we are making that contribution. So the way you keep it in your books is you simply debit a plan asset and credit bank. And if it is unpaid, you book it as a liability, you credit accrual. So contribution is made into a plan asset. Debit plan asset, credit bank. The second item that the actuary will give us is the current service cost. And this current service cost is actually speaking to the way in which that actuary built up the benefits. So this current service cost is actually the annual benefits that we owe the employee, that every year that the employee works for us, what he is entitled to every year is this cost. You need to understand, we are not paying this current service cost this year. It's not like we are paying it this year. It's something when he retires. But based on projected unit price method, we told the actuary to build it up on an annual basis. So that annual basis is what we call current service costs. So is the annual obligation that the entity has for the employer for their services in the current year. Current service. That, okay, you have worked for us this year. We owe you a retirement benefit for the fact that you worked this year. That is current service cost. For your current service this year, this is what we owe you. Whatever give us as current service costs, we debit P&L because that's an expense. The employee has worked for that year, so we debit P&L, and we simply credit the present value of defined benefit obligation. Present value of defined benefit obligation. So this present value of defined benefit obligation is the liability, is the obligation itself. So while this current service goes to P&L every year, you see this one, something will be carrying forward, that it is for this obligation that we will know that after 5 years, when we go and peep into this account, we will have seen what we owe our entire force is going to be in this account. So I'm sure you're understanding the fact that it is this current service cost that actually builds up benefits. Because every year you debit P&L, you credit PV of defined benefit obligation. Every year you're doing that. Every year you're doing that. So the PV keeps ballooning. It keeps growing. Every year it keeps growing. And that's our obligation. That's the retirement benefit itself. The next one is the past service cost. And past service cost is a change in the obligation. Is a change in the defined benefit obligation. When I change, is either increase or decrease. Now, this change will usually arise because of either an amendment or a curtailment. This change in obligation will arise either because of an amendment, curtailment. And an amendment is an introduction of a new plan by an entity. It's just like the entities want to introduce medical care for all its staff. The company is doing so well, and it says, okay, I want to better the lot of my staff when they retire. I want to start a scheme for you guys. I want to start contributing additional money that when you retire will take care of your medical bills. I mean, when they introduce a new benefit, and it's like an additional benefit to the employee. We call that an amendment, an introduction of a new. But ultimately, sorry. So curtailment, this is a closure of part or an entire defined benefits plan. It's just like the entity is saying, I'm not doing again. In fact, that medical care plan that we said we wanted to do for everybody now is cancelled. I mean, you can guess. It's either because the company is not doing so well, or probably the company is liquidating, or there's a decline in their financial performance. I mean, that's the only reason why they want to close a plan, a retirement plan for their employee, a defined benefit plan for their employee. So for us accountants, what we just need to understand is this curtailment is going to reduce our obligation. So while amendments will increase our obligation. So this increase or decrease is what we call past service costs. And this past service cost, we debit it to P&L because is an expense, and we credit the obligation. That's if it's increasing the obligation in the case of an amendment. It's amendment that will increase the obligation. But if it is a curtailment, we would have to debit the obligation, PV of defined benefit obligation, and we'll credit past service cost with the decrease in defined benefit obligation in the case of a curtailment. And that's past service cost, change in obligation as a result of an amendment or a curtailment. Amendment is an introduction of a new plan. Curtailment is a closure of part or an entire plan. That change in the obligation is past service cost. It goes to P&L. The next is benefits. This will arise when the employee retires. So when an employee retires, we need to pay benefits. And we do this by debiting the obligation, because when we pay benefits, the obligation reduces. And also, we credit plan assets. We are crediting plan assets because that is where we are going to take the benefit from the contribution we have been making. Remember, we have been making contribution into a plan asset. So when employee retires and we need to pay benefits, we simply go to our plan asset and take money from there to settle those employees. So we debit PV of defined benefit obligation, we credit plan asset. Then we have settlements. This will arise when there is a curtailment. That is where we can have settlements. So if an entity closes a plan, we'll have settlement. Because we will have to transfer the plan assets to the employees and will equally erase the obligation. And it could also be that the employee leaves before retirement. It leaves to another employer. That could also result in settlement, but we need to settle. So it's almost the same thing as paying benefits. The only difference is that while the obligation is, let's say, 50 million, the employer will usually negotiate a settlement price lower than the obligation. Because usually it might be because the company is not doing well, or because the employee wants to leave. So they would negotiate that, okay, this 50 million we are owing you, you can only pay 45 million. So we are definitely going to book a 5 million gain on settlement. And this is how we recognize it. The obligation will cancel out 50 million. The plan assets, we are only removing 45 million. The balance will go to P&L as a gain on settlement. I can tell you for free that for your exams, when it comes to the post-employment benefits, which is the one they mostly ask in the exam, this is the one that I'm spending so much time on it, is the one you really find in your exams. So we just need to know these five, how to account for these five, then you're fine. Let me quickly show you something. Let me show you something. You see, those double entry that I just finished giving you, all of them affect plan assets, and they also affected DBO. So this is just like a summary, which is what you would majorly have to do first in your exam. So usually, let's say there was no balance brought forward in the two. 0, 0. The first item we have in that schedule was contribution. And I told you that contribution goes to plan asset because we are contributing into a plan asset. Then the next thing I gave you is current service cost. I said current asset, current service cost. And I told you that this is what built up the obligation. This is the obligation we have to the employer, to the employee, I mean, for the service in the current year. So this one will impact DBO, to increase the DBO. Then the next was past service cost. This one will either increase or decrease the DBO, depending on whether it's an amendment or a curtailment. Past service cost. Then we mentioned benefits. This one, we are taking out from our obligation because our obligation will reduce. It's like the employee retire, so obligation reduces because we're going to settle it. And we are taking out the money from the plan assets. That will also be in jackets. So it reduces our plan asset. Then finally is settlement. So for the settlement, I told you the figures will not be the same. Like in this scenario, if the obligation is, let's say, 50 million, and we settled with 45 million, so there will be a net that is 5. There's usually like a net that we usually have here. In this case now, this net is what will go to P&L. I've seen in some questions, which we are going to see today anyway, where the examiner will give you the obligation and the what we settled with. They will just tell you that, there was a curtailment and we made a gain on settlement of 5 naira. That's all they will tell you. There was a curtailment and we made a gain of 5 naira. That's all the examiner will tell you. How do you treat that one? Do you just take that gain to P&L? You'll be wrong if you do that. The right way to do it is that for you to have a gain on settlement, it really means that the settlement price was lower than the obligation. It really means that you were owing like 50 naira and you agreed, you negotiated with the employee that, I will only settle, I will only give you 45 naira. So if the employer just tell you, they didn't give you these figures, and they tell you that we made a gain on settlement, you have to ensure that you come and put 5 here and assume this one is 0. Then you can then extend your net as 5. You must do this. Otherwise, the balance you will get for DBO and plan asset to be wrong. You must do this. So if they don't give you the full figures like this, and they just tell you that, okay, we made a gain, you must know that for you to make a gain, it means that the obligation is higher than the settlement price. We settled for less by that amount of gain. So you remove that differential from DBO, which is the defined benefit obligation, and we'll assume this is 0. Any questions to this point? Now, eventually, we are going to cumulate this entire amount. We'll cumulate this entire amount. We'll add everything together. We'll call it carrying amount. We'll call it carrying amount. Let's assume when we added all the figures in the DBO together in this schedule, let's say we got 7 naira. And in the plan asset, we added everything together, we got 9 naira. What we put in our books, we don't recognize these 9 and 7 individually. What we put in our books is the net of the two. The net of the two. In this case now, the plan asset is higher than the obligation by 2. That means these 2, we're going to recognize it as, we call it net defined benefits assets. Net defined benefits assets. Sometimes they call it surplus. But if it was the obligation that was higher, you can guess that these nets will be called a net defined benefit obligation, or they simply call it deficit. And finally, because this current fixed cost and even this contribution, the actuary usually determine it using a present value basis. That's why they call this liability PV of DBO. You usually discount it to value. So accountants will usually unwind the discount to account for that time value of money. So as we are moving through time, we need to be unwinding the discount. And we usually unwind discounts using interest. So usually that interest, the examiner will give you an interest rate, like 10%. it is usually calculated on the opening figures. So it will be 10% of opening year, 10% of opening year. And this is everything that you need to know. Now, this is the first thing you always do in the exam. As soon as you have done this, what is left that the examiner might ask you is to prepare your statements. So if you want to prepare a statement of profit or loss and other comprehensive income, from this schedule, what will go to P&L? The first one will be these interests, which will usually be net, because there will be a figure here, there will be a figure here. There will be a figure under the obligation and under the plan asset. We usually take the net to P&L. I will show you when we solve the question. Another item that goes to P&L is the current service costs. Current service cost also goes to P&L. Another one is the past service costs. The past service costs also go to P&L. Finally, lest I forget, this gain on settlement. The gain on settlement also goes to P&L. And that's all that goes to P&L. Then, in other comprehensive income, we have two items. We usually have two items. Number one is actuarial loss or gain. I've not explained this, so I will definitely explain it with a question so to be clearer. And there's something called return on plan assets. We'll also explain this as well. Then, in my statement of financial position, like I told you, what goes into books in respect of this carrying amount is the net of the DBO and the plan asset. If the plan asset is higher, we would have a net defined benefit asset that will come in under our non-current assets. We will have a net defined benefit assets. But if the PV of DBO is lower, that will come in under non-current liability, and we'll have a net defined benefit obligation. Sometimes they simply call this surplus. And this net defined benefit of obligations, they simply call it deficit. And that is all you need to know for post-employment benefit plan, specifically defined benefits plans. Any questions? Okay. Let's solve questions. Let's solve this question set. This one says that at 1st January 2002, the value of the asset of a defined benefit plan were valued at 1.1 million, and the present value of the defined benefit obligation was 125. On 31st December 2002, the plan received contribution from the employer of 490 and paid out benefit of 190. The current service cost was 360. Discount rate 6% is to be applied to the net assets or liability. After these transactions, the fair value of the plan asset at 31st December 2002 is 1.5 million. And the PV of DBO was 1.553600 required. Calculate gain or loss on remeasurement through OCI and return on plan assets and illustrate how this pension will be treated in the statement. Okay. So in the exam, they'll give you something like this. The first thing you need to do is to do your workings, because every one of these transactions will affect DBO and plan assets. Then you have a net defined benefit asset or obligation. So we start with the balance at the beginning of the year. So at the beginning, we're given in the question that the value of our obligation is 1,250 and the value of our assets is 1.1 million. And that is what we have here, 1,250, 1.1 million. And immediately we will calculate the interest, the net interest, so that we won't forget. And the question will always give us a discount rate. They give us 6%. So we apply this 6% on the opening figure. On the opening figure, it gives 5,000. The same thing on the plan asset opening, it gives 66,000. In this case, the interest arising from DBO is the interest expense, because that's a liability. The interest arising from plan asset is the interest income, because that is asset. What we recognize in our books is the nets. But because the nets, the interest expense arising from DBO is higher than the interest income arising from assets, that is why we are having this in jacket, because it results in a net interest expense. We'll have a net interest expense. Okay. Then we're given contribution. They told us that they made a contribution of 360,000, Abi, of 490,000. So we'll have contributions, and that will be added to the plan asset because we are contributing into a plan asset. So we add it to the plan asset. Then they told us that they paid out benefits of 190. So we have benefits. When you have benefits, you take it out from the obligation, because your obligation will reduce by the amount of benefits. And you also take it out from the asset, because you are settling the obligation from your plan asset. So out. Thereafter, we're given current service cost of 360,000. So we have current service cost. It usually affects the obligation, 360,000. And those were all the transactions. The remaining were, they now fair valued the plan assets, because the actuary will usually get the fair value. He will also, in his report, you will find fair value. So in the exam, they always give you the fair value of the plan assets and the fair value of the obligation. As given here, they will always give us. So what do we do with that? First, let's get our book value from our schedule. You accumulate this one, this one, this one, this one. It gives me 1495. I'll do the same thing. It gives me 1466. In this case now, you find out that my obligation is higher. Ordinarily, I should have a net defined benefit obligation that will simply go and put in my non-current liability. But since I have been given fair value, so I would have to record these transactions at fair value. So for the obligation, I was given a fair value of 1553. And for the plan assets, I was given a fair value of 1500. So instead of recording 29,000, I would then have an obligation of 53,600 that would be recognized under my non-current liability. So in this case now, there's a change in liability. There's a change in valuation, and my liability has increased. That's a loss to me. So if you get the difference between these two, that's what we call actuarial loss. Whatever it is, there is a difference. But in determining actuarial loss, I want to advise to use this basis that I'm teaching you, because it can get complex, as you are going to see very soon. It will not all be as simple as this. So in determining your actuarial loss, don't use this one as basis. Come and calculate them individually. Calculate for DBO. Compare the book value of 1495. Compare it with the fair value. You will see that the obligation is higher. I mean, in your books, we are saying I owe 1495. The actuary is coming and saying that, no, you owe more than that too. That what you owe is 1.5 million, 1553. That's a loss. That's a loss to us. We call that actuarial loss, 58,600. The same for the assets. In our books, we are having 1466. But the actuary came and said that, no, your asset is actually 1.5. Wow, that's good. So our asset is even higher than expected. That's good for us. So in our books, we would have a gain, which we call return on plan assets. That's a gain for us. Return on plan asset. Now let's prepare our statements. In our POL, current service costs, 360,000, net interest, 9,000, they all go to P&L. In my other comprehensive income, actuarial loss, 58,600, return on plan assets, 34,000. All of these are here and here. All the figures are from these schedules. You just need to know which one goes to where. In my statement of financial position, since the fair value of the obligation is higher than the fair value of the plan asset, that means I'll be having a net defined benefit obligation, which I will recognize under non-current liabilities. So, under my non-current liabilities, I will have a deficit or a net defined benefit obligation of 53,600. And that's the end of this question. So I believe that's clear. Let's solve another question. It says that for the sake of simplicity and clarity, all transactions are assumed to occur at the year end. The following data applies to the post-employment benefits compensation scheme of PCD Co. They give us discount rates, PV of obligation at the beginning of the year, market value of plan asset at the beginning of the year. And they gave us the following transactions are relevant: current service cost, benefit, contribution, and the fair value, the year-end balances. And they gave us some additional information for 2003 and 2004. Okay. When I get to 2003, I will deal with this additional information. And I'll say, show how reporting entity should account for this defined benefits plan in 2002, 2003, and 2004. So in 2002, I'll start with my workings as usual. So I'll have DBO, plan assets, and the nets DBO or assets. And my NERA in thousands, because the question was in thousands. So at the beginning of the year, they gave me 1 million for both asset and obligation, which I put here. 1 million, so that I won't forget. I immediately determine my net interest, which the question gave me a discount rate of 10% here. I was given a discount rate of 10%. So 10% of 1 million, 100,000, the same thing here too, 100,000. So the net is 0. I was given a current service cost of 140. So I'll have current service cost 140. Current service cost will be added to the DBU. I was given benefit paid of 120. For benefit paid, it reduces my liability, it reduces my asset. Because while I'm settling liability, I will actually be depleting my asset. So we take it out from the two. Then we have contribution paid, 110. So contribution, we add it to the plan asset, 110. And that is all. The remaining one are just the fair value. Those are all the figures for 2022. So when I cumulate the value in obligation, I get 120. When I cumulate the value in asset, I get 1090. All I just need to do is to compare them with my fair value. So I was given the fair value. Obligation 12, plan asset 1250. So obligation 12, plan asset 1250. So firstly, in my statement of financial position, is the net that will show. In this case, the plan asset is higher than the obligation. So I will have a net defined benefit asset because the plan asset is higher. Secondly, I will need to calculate my actual loss or return on plan asset. So starting with the DBO, in my books, my obligation was 120, but the fair value in the actuary's report is saying that my obligation is higher than that. And it is 12. So it's higher by 80. So I have a loss. I call it actuarial loss. But my asset is also higher as well because it was 1090 in my books. Now it is 1250. This is a gain. Return on plan assets is a gain. In 2003, my balance brought forward becomes the closing values from last year, which are the fair value. So 1,2, which was closing, becomes 1,2 opening year. 1,250, which was closing, becomes 1,250 here as opening. Firstly, I will need to determine my net interest at 10%. This gives 120, 10% of 1,2, and 10% of 1,250 gives 125. In this case, the net income or the interest income is higher than the interest expense by 5 naira. So we would have a net interest income, 5,000. Then I have my current service cost of 150, benefit paid out of 140, contribution paid of 120. So in 2003, current service cost will be added to DBO. Benefits paid out will be taken out from DBO and plan assets. Contribution paid will be added to plan assets. So let's go and look at the additional information in 2003. It says at the end of 2003, a division of the company was sold. As a result of this, a large number of employees of that division opted to transfer their accumulated pension settlements to their new employer's plan. Assets with fair value of 48,000 were transferred to other companies' plan, and the actuary has calculated that the reduction in obligation is 50,000. The year-end valuation in the table above were carried out before this transfer was recorded. Okay, so in this case now, the company sold the division and they had to sack some employees. So the scheme, the retirement scheme had to then be transferred to the employee's new employer. I mean, this is a typical curtailment, but there was now a settlement because we were settling with assets. But the key thing is that we are settling 48,000 for an obligation or a liability of 50,000. That means we are gaining 2,000. So the way that works, we'll have settlement. The obligation was 50. The settlement price was 48. There will be net of 2 as gain. And they also said that the year-end valuations in the table above were carried out before this transfer was recorded, which means that the fair value they gave us in 2003, they were valued before this settlement and this obligation were carried out, before they were determined. So here we have removed it from here, quite all right. But in these valuations given, you have to remove it here also, because it wasn't considered. So that we'll be comparing like with like. And that's what that sentence is telling us, that this year-end valuation, they were determined before the transfer took place. So in 2002 or 2003, by the time we cumulate all items in DBO, our book value is 1,280. By the time we cumulate all items in assets, our book value is 1,307, which we're going to compare with the fair value of the DBO and plan assets. They gave us the obligation as 1,650. So that means my fair value is 1,650. I will have to remove this transfer, this obligation that was settled, because it hasn't been removed here. So I remove 15 naira here as well. So I'm left with 1,600. See, with this 1,600, now higher than the book value, I will be having an actual loss of 320. I'll be having an actual loss of 320 because my obligation is now higher. For the asset, the fair value of my asset was 1,450. But they have not considered this transfer, this settlement price, so we need to remove it here as well. So I'll be left with 1,400 as fair value. And again, this 1,400 is higher than the book value. So again, I'm having a gain of 95. We call that return on plan assets. We call that return on plan assets. In my statement of financial position, I will put the net of these fair values. In this case, the obligation was 1,600. The assets is 1,402. So the difference is 198, and it will come in as a net defined benefit obligation because the obligation is higher. I would advise you to go and practice this on yourself. It's the same thing. And you can prepare these statements. It's the same as the first question. But let's read this additional information together and know what it is. It says in 2004, at the end, a decision was taken to make a one-off additional payment to former employees currently receiving pension from the plan. This was announced to the former employees before the year end. This payment was not allowed for in the original terms of the scheme. The actuarial valuations of the obligation in the table above includes the additional liability of 40 relating to this additional payment. So what is this 40? So they are making a one-off additional payment to former employee. Okay, one-off additional payments. So for them to have made a one-off additional payment, this is an amendment because it's like an introduction of a plan. It's going to increase our obligation. So this change in obligation of 40,000 will be treated as a past service cost. And that will reflect in year 4 as past service costs that will be added to our obligation. And of course, it's also showing P&L. So try your hands on 2004 and also the statements. And that's the end of this question. Any questions? Let's solve one more question. The reason why I'm solving this is I want to teach you one last principle. This question says that Apolline Co. manages a defined benefit scheme for its employees at 1st January 2008. The fair value of the pension scheme assets were estimated to be 135 million, and the present value of the pension scheme liability were 122 million. The asset ceiling has been calculated as 4 million. Okay, wait, what is asset ceiling? So that's a new thing that I want to talk about. And that's why we are solving this question. Okay, so let's rewind. let's rewind. So at the beginning of the year, the fair value of the assets is 137. The present value of liability is 122 at the beginning of the year. That means this is a brought forward from last year. That means last year, what we would have recognized in our books would have been net defined benefit assets of 15, because my scheme asset was 137. The scheme liability was 122. You will see that the asset is higher in this case by 15. It's higher by 15. Abi, that's what we'll have shown. That's what should have shown. That 5 net is what we show in the statement of financial position. However, there's something we call asset ceiling. So asset ceiling is just coming to say that the assets that you recognize in respect of a net defined benefit asset, like in this case, this 15 naira that we are having, which is 137 minus 122, that happens to be an asset, that is it really an asset? Are you going to really get an economic benefit from it? Because when we put an item as assets in our books, accountants, the way we interpret that is that the asset should generate future economic benefits relating to that amount or equaling that amount. So if you recognize 15 naira as a net defined benefit asset, it means that it means we're expecting a benefit of that 15 million. So the standard says that let's look deeper into this net defined benefit asset. That's what benefits can we get from it that can qualify it to be an asset? So there are two. Number one is either you are getting a refund from the plan assets. Because for you to have a net defined benefit asset, it means your scheme asset is higher than your scheme liabilities. And for your scheme asset to be higher, it means you have over contributed. You have contributed so much. You have contributed so much. So the benefit you can get is they should refund some of your contributions. Or if they can't refund your contributions, then there should be a reduction in future contributions. So those are the benefits we feel that we can get from a net defined benefit asset. So in most instances, those benefits we can get, the question would call it asset ceiling. They will just put an amount to it. In this case, they said it's 4 million, which means that 15 million that we think we have as assets, we cannot recognize everything as an asset because the benefits we can get is actually 4 million. This asset ceiling is either reduction in future contribution or refund from the plan. Refund, they give us some of our money back. It's 4 million. That's the maximum we can get. So that goes to show that we are overvaluing our assets by 11 million. So that means last year, what they will have recognized as assets is not that 15 million. It will have been this 4 million. It will have been this 4 million. So you can guess that for us to bring down that asset from 15 million to 4 million, we will have passed some double entry. Of course, we want to reduce the assets from 15 to 4. So we credit the asset. the corresponding debits cannot go to P&L because this is a remeasurement of asset. So the corresponding debit will simply go to OCI. We'll call it ceiling adjustment. It goes to OCI. So last year, 11 million will have gone to OCI to bring down the asset to the asset ceiling of 4 million. So before I move ahead, do we have any question? Because that's the only new thing here. Every other thing are things we have discussed before. Any questions? Okay, good. So the discount rates on high quality corporate bonds is 4 million. Now say the following are details of the scheme: contribution, benefits, current service costs. So at the end of the year, now at the end of this year, now they came up with asset ceiling again, and they said it's 11 million. So meaning that if you have a net defined benefit asset this year, it must never be higher than this 11 million. Otherwise, we have to bring it down to 11 million. So during the year, there was a scheme curtailment, which resulted in a gain on settlement of 3 million. I explained something around this, that when they just give you gain on settlement without giving you how they arrived at it, so you need to ensure that you adjust that schedule properly, which I will show you very soon. And I said immediately after the scheme curtailment, they actually value the scheme assets at 148 million, scheme liabilities 136 million. Okay. Again, the first thing we'll do is our table. The assets, the scheme liabilities, and the nets. So at the beginning of the year, the scheme asset, as we saw earlier, was 137. The scheme liabilities was 122. There's a net of 15, which is a net asset, net defined benefit asset. However, there was a ceiling adjustment. There was a net ceiling of 4 million. So we need to bring down this 15 to 4. That means we remove 11. We call that ceiling adjustment. Remove 11. So it brings it down to 4. Now, as soon as we sort out that, we need to immediately sort out the net interest. And for the net interest, we apply 4% of 137 million, which is 5.48, and 4% of 122 million, which is 4.88. Now, the asset is higher than the liability. So we have a net interest income. However, since it was 4 million that we recognize in our books as assets at the beginning, and not this 15 million, so what will come in as net interest income will be 4% of this 4 million. This is what we recognize. So the fall, call that also ceiling adjustment. The question told us there was a contribution of 7 million. Then they paid out a benefit of 6. We take it out from the 2. And there was a current service cost, which we are going to add to liabilities. And there was a gain on settlement. And I've explained this one. They told us that there was a gain on settlement of 3 million here. Gain on settlement of 3 million. This 3 million, you need to assume that the asset is 0 and the liability is 3, so that we can have a net gain. Don't just go and put the gain in P&L. You need to impart it on this schedule. We'll remove 3 from here. Because for us to have a gain, it means our liability was higher. It means we settled for less. So we assume that, okay, if the settlement price is 0, that means our liability was 3. And we settled 0. So the gain will come here. And that's all for this question. But let's put the final touches to it. By the time we accumulate all the assets together, it brings us to this. When you accumulate all the liabilities, it brings us to this. And that's the balance at the end. That's the carrying amount. But they gave us fair value. The question gave us fair value of the asset and of the liabilities. 148, 136. So 148, 136. In this case, the scheme asset is higher, being 148. The liability is 136. So we're going to have a net defined benefit asset of 12. But remember, at the end of the year, there was an asset ceiling of 11, which is saying that the benefit you can get from this asset is actually 11 and not 12. So what we recognize in our books is not 12, but 11. So we need to write it down by 1 as a ceiling adjustment that we're going to take to OCI. And that's the end of this question. And that's how you treat asset ceiling. Any questions? Now, technically, I'm done with this topic. These are 2 other long-term benefits. There is nothing to it. So why is there nothing to it? Because other long-term benefits are benefits like the ones you get after 1 year, like your employer telling you that when you work for us for 5 years, we'll give you a car, or we'll give you a house, or a long-term service award, something like that. So it's also a future benefit and it's defined. So it's very similar to defined benefits. So the treatment is the same. So usually we'll get an actuary to value it for us, and he will give us all those figures I've explained so far. But because most organizations don't contribute against other long-term benefits, mostly other long-term benefits, they just happen. Mostly is not planned. Yes, okay, I want to go for long service leave. Oh, you are now entitled to a car. Most of them don't contribute. So mostly we would really account for it when they occur. But theoretically, the standard says that the ideal situation is that it should be contributed for, and you should get an actuary to do those valuations for you and all of that. So similar to everything I taught you under defined benefit. The difference is that for other long-term benefits, we will not have any item that goes to OCI. All actuarial losses, ceiling adjustments, return on plan assets, everything is in P&L. So we'll not have, so they're just trying to make it a little simpler for us. The termination benefits. So this one is either the employer fires the employee or the employee says it's going. Whatever the case, if there is a benefit that is payable, it happens at retirement. So it's just to credit bank and debit staff costs. So it's not like anybody plans for firing another person. So it's not something we plan for. Anytime it happens, we book it. So there is really nothing difficult in termination benefit. At any time that we need to pay those payments, those
termination payments or redundancy payments, just credit bank with debit staff cost. That's the end for this topic. So there are some questions here that I really need you to practice. Though the solution are here is the same thing as we have learned. There is nothing different. It's the same thing. You can never have anything beyond what I've taught you in this class today in the exam. It's not possible. And there was this very simple one they asked, I think in 2023 or so. You can check it out. It's very straightforward. It was on defined contribution plan. You can check them out. So next week, we're going to be starting chapter 5, financial instruments, will be our topic for next week. So thank you very much. See you next week.
Thank you, sir.